Equity Lifestyle Properties beat the midpoint of management's own guidance for Q2 2026. Normalized FFO came in at 74 cents per share, which represents a 7.7% year-over-year increase. Net income hit 50 cents per share, and total Q2 revenues climbed to $397.8 million.
Really solid top line there.
Yeah, across the board. Management immediately nudged the full year 2026 normalized FFO midpoint up to $3.18 and updated their net income guidance to a range of $2.05 to $2.15. And heading into this earnings release, the stock closed the quarter on June 30th at $64.45, giving them a total market cap of $16.25 billion.
So for you, the retail investor tuning in, the analytical mission today is straightforward but absolutely vital. We're going to unpack the segment performance, analyze the underlying margin expansion, and really review management's commentary.
Right, to see where the growth is actually coming from.
Exactly, to reveal exactly how ELS generated 6.5% growth in core income from property operations despite some very real, very heavy friction underlying their business units.
Because when you look at that top-line earnings beat, the initial assumption is that everything in the portfolio is firing perfectly in unison.
Oh, sure.
But the moment you start peeling back the layers on this report, there is a really distinct, fascinating divergence between their asset classes. We have to start with the core manufactured homes, or MH, segment. This is, the absolute bedrock of equity lifestyle properties.
It is the underlying engine that powers everything else they do. Core MH base rental income rose 5.8% year over year. And to understand why that cash flow is so intensely reliable, you really have to look at the mechanics of the asset class, specifically their scale and their pricing power.
Right.
ELS is operating over 73,300 manufactured home sites, and they're running at an ironclad 93.8% occupancy rate across that massive portfolio.
And the rent itself is the key detail here that explains the stickiness of that occupancy. Average monthly base rent is creeping up, yes, but it is still just $956.
Which is incredibly low.
Right. If you look at the current housing market, a $956 monthly payment is incredibly rare. Tenants simply do not have cheaper alternatives. Furthermore, these are land lease communities.
Yeah, that's a crucial distinction.
The tenant owns the physical home, but they pay ELS for the dirt it sits on. Moving a double-wide manufactured home to a new park can cost, upwards of $10,000. So once a tenant is in, they are economically incentivized to just stay forever.
Precisely. The switching costs for the consumer are prohibitively high. It's the ultimate affordable housing play disguised as a real estate investment trust. And it's not just the site rentals generating that cash.
Right, they have the home sales too.
Exactly, an active home sales pipeline built right into the core model. In Q2 alone, they moved 235 new and used homes. The new home sales generated over $9 million in gross revenues.
Wow.
And the used homes brought in about $698,000.
So it functions like a self-sustaining ecosystem. They sell you the physical home, recognizing that revenue up front, and then you pay them rent for the land underneath it indefinitely. It's an incredibly efficient way to capture both capital and long-term recurring revenue.
Yeah, it's brilliant.
So the MH side of the ledger is looking phenomenal. But here's where it gets really interesting and, frankly, a bit concerning. We have to contrast that phenomenal MH stability with the friction we're seeing in the RV and marina segment.
Right, because the divergence between the two is stark. If you look at the core annual base rent for RVs and marinas, meaning the people who rent a space for the entire year to park their boat or RV, that grew a very healthy 5.4%.
That's solid.
It is, but the total segment growth was dragged down to a sluggish 1.8% for the quarter.
And the culprit dragging that down is the short-term renter. Seasonal and transient RV rentals plummeted 9.6% year over year, dropping all the way down to $21.9 million.
Which is a huge contraction for a remarkably high-margin part of their business. Think about the unit economics here. When someone pulls an RV into a spot for a single weekend or even a month, they are paying a premium daily rate compared to the annual lessee.
Right. It's essentially hotel pricing versus apartment pricing.
Exactly. So when that transient demand dries up, it hits the segment's growth rate disproportionately hard.
To put this in perspective for you listening, I look at the MH segment like a high-yield treasury bond. It is predictable, sticky, almost guaranteed cash flow. But this transient RV segment, it trades much more like a cyclical discretionary consumer stock.
Oh, absolutely.
It is acutely sensitive to vacation demand changes, weather, fuel prices. So I have to ask you, Looking at this near 10% drop in transient revenue, is this just a minor normalization blip, or is this indicative of a broader macroeconomic headwind that's finally hitting retail consumers?
That is the critical question this earnings report forces us to ask. If we connect this specific data point to the bigger macroeconomic picture, management explicitly notes in their forward-looking risks that changes in customer demand regarding travel and outdoor vacation destinations are a major factor.
So they're seeing it too.
Yeah, the consumer might still be employed, but their discretionary travel budget is clearly tightening.
Which makes perfect sense when you look at the real-world costs. The cost of financing a new $100,000 RV is significantly higher today than it was 3 years ago. The cost to fuel a Class A motorhome getting, 6 miles to the gallon? That's higher. The campground fees are higher.
Exactly. We are seeing all of that reflected in the transient bookings. It suggests that the bottom end of the consumer travel market is feeling the pinch, forcing them to pull back on those casual weekend trips to the campground. I mean, the math just doesn't work for the average household the way it did during the outdoor travel boom a few years ago.
Which makes their overall earnings beat even more impressive. I mean, if your high-margin transient RV revenues are dropping by 10%, how in the world do you still manage to beat guidance and expand overall core property operations income by 6.5%?
It's a great question.
The math only works if you are either ruthlessly slashing overhead or finding a backdoor revenue stream to plug the gap.
And they executed brilliantly on both fronts. This quarter was a textbook demonstration of aggressive expense control and the acceleration of recurring subscription revenues. Let's look at the margin defense first, because the underlying mechanics of how they pulled this off are fascinating.
Yeah, let's get into that.
Total core property operating expenses, and this excludes property management overhead, mind you, were kept to a remarkably modest 2.9% increase. In an inflationary environment where labor, materials, and services are surging across the broader economy, holding operating expenses to sub 3% is a massive operational win.
But you can't just mandate inflation away, which means they're either deferring necessary maintenance to make the quarter look good, or they found a structural loophole in their fixed costs. Which is it?
It's the latter. They found structural efficiencies, and you really have to look at the specific levers they pulled to understand how. First, let's look at real estate taxes. They managed to keep real estate taxes completely flat at $21.2 million for the quarter.
Wait, flat real estate taxes across 400-plus properties in this environment? That is almost unheard of. How do you keep municipal governments from raising your assessments?
It speaks to their aggressive tax appeal strategies. A company of this size employs teams dedicated solely to contesting property tax assessments across their geographic footprint.
Oh, I see.
When municipalities try to hike the valuation of a mobile home park, ELS fights back, arguing for lower valuations based on the specific usage of the land. It's a hidden margin driver that most retail investors completely overlook.
That's a great point.
But even more surprisingly this quarter, their insurance and other expenses actually contracted by 2.0%, dropping down to $25.8 million.
Wait, keep in mind, this is a real estate trust heavily exposed to coastal Florida and California. The insurance markets in those states are in an absolute crisis right now.
Totally.
We are seeing premiums double or triple for standard commercial real estate. Seeing insurance costs actually go down year over year is a major tailwind for their margins. But again, how is that physically possible? I have to hypothesize that they didn't just negotiate a cheaper premium. They must have restructured their actual risk profile.
Your hypothesis is spot on. In commercial real estate, when you see a drop like this in a high-risk geography, it almost always means management fundamentally changed how they buy insurance. They aren't getting cheaper rates for the same coverage.
Right.
Instead, they are likely taking on much larger self-insured retentions, meaning they pay a much higher deductible out of pocket before the insurance kicks in. Or they're leveraging the massive scale of their 400 property portfolio to pool risk differently than a smaller operator could.
So they're taking on more risk themselves.
Exactly. It's a calculated gamble. They are taking on slightly more immediate financial risk to suppress those surging premium costs on the income statement.
And it worked, at least for this quarter. There's another fascinating margin lever they pulled here, too. They improved their utility recovery rate to 50.5%.
Yes, and the mechanics of utility recovery are a perfect example of squeezing efficiency out of legacy assets. Historically, an older RV park or mobile home community might have had one master water or electric meter, and the park owner just absorbed the cost as part of the rent.
Right. Very common.
But what ELS has been doing is aggressively sub-metering their properties.
So they're installing individual meters on the RV pedestals and the manufactured home lots.
Exactly. When a tenant's lease rolls over, the new lease stipulates that the tenant pays their own exact usage. By pushing that recovery rate over 50%, they're getting better and better at passing the surging costs of water, electricity, and trash directly back to the consumer rather than eating those inflationary increases themselves.
That is pure margin expansion.
Completely.
Okay, so they brilliantly defended the bottom line by capping expenses through tax appeals, insurance restructuring, and submetering. But they also went on the offensive with their membership strategy. This is where ELS stops looking like a traditional real estate company and starts looking remarkably like a modern SaaS business.
That is the perfect analogy. Let's look at the campground and membership data. Annual membership subscriptions spiked 10.8% to $18.5 million in the core portfolio. ELS now boasts 107,857 total memberships across 82 campgrounds.
That's the massive user base.
It is. These members pay a significant annual fee up front for access to the campground network. And that generates serious recurring cash flow, regardless of whether the member actually pulls their RV into a spot on any given weekend.
They originated over 8,700 paid memberships just in the first half of this year alone. But I have to challenge this dynamic a bit. When I look at those numbers side by side, the 10% drop in transient revenue against the 10% spike in membership revenue, it raises an important strategic question.
Okay, what is it?
Is this membership program actually a structural moat that permanently locks in customer loyalty? Or is it essentially just a strategic Band-Aid management is using to cover up the bleeding in the transient RV numbers? Are they just cannibalizing their own high-paying nightly renters by forcing them into discounted annual passes?
That is a very sharp distinction to make, and it really gets to the heart of their current strategy. What's fascinating here is that it's likely a bit of both, but heavily leaning toward a structural moat.
Okay.
Yes. When you convert a transient weekend guest into an annual member, you do lose that high nightly premium rate. You are technically cannibalizing your own yield on that specific site.
Right, you're trading an $80 a night booking for a pass that might only equate to, say, $20 a night if they use it frequently.
Exactly. But what you gain in return is absolute predictability. You secure their capital upfront in January for the entire year. This smooths out the severe cyclicality you mentioned earlier. Even if the consumer travels less because gas is expensive or the weather is terrible all spring, well, ELS has already collected the membership fee.
That makes total sense.
So while it does offset the transient losses on the balance sheet today, serving as a bit of a Band-Aid long-term, it transitions the RV portfolio away from weather-dependent weekend warrior revenue and towards a highly defensive, predictable subscription model.
They are intentionally trading peak season upside for year-round downside protection. And all of this, the margin defense, the submetering, the subscription growth, it all drops straight to the bottom line. It resulted in funds available for distribution, or FAD, of $121.6 million for Q2.
A very healthy number.
Yeah, that is the actual cash they have available to play with after maintaining the properties. So what does this all mean for capital allocation? How is management utilizing that cash, and what external risks are threatening the balance sheet?
Management is being highly strategic with that capital, specifically regarding acquisitions and balance sheet consolidations. A notable move happened on April 30th. ELS acquired the remaining 20% of their RVC joint ventures for just $4.4 million in cash.
And the numbers on this are staggering. They spent $4.4 million in cash, but it added $102.9 million to their net investment in real estate. For the listener trying to wrap their head around that math, how exactly does a $4 million purchase unlock over $100 million in real estate?
It's a brilliant bit of joint venture accounting. Prior to April 30th, ELS already owned 80% of this joint venture, which included 7 RV properties and a land parcel. But because they didn't own the whole thing and the minority partner had certain rights, ELS couldn't fully consolidate those massive assets onto their main balance sheet.
Oh, they had to account for it differently.
Right.
So by buying out that final 20% for $4.4 million, they crossed the threshold of absolute control.
Exactly. That small cash outlay removed the minority interest, allowing ELS to legally pull the gross asset value of all those properties directly onto their balance sheet. It's an accounting unlock. It streamlines their portfolio, gives them total operational control over those 7 properties, and vastly inflates their stated real estate assets for a minuscule amount of actual cash.
And when you look at the broader balance sheet supporting all this maneuvering, it is built like an absolute fortress. Total debt sits at $3.33 billion. Now, to the everyday investor, $3 billion sounds like a massive liability, but it's a very conservative 20.5% of their total market cap.
Very low leverage for a REIT.
Yeah, and their debt to adjusted EBITDA is just 4.4 times. And for those looking at the financial glossary, EBITDA is basically their pure operating cash flow from real estate, meaning a 4.4 multiple gives them a massive amount of breathing room to service that debt.
The overall leverage is wonderfully low, but the structure of that debt is where their financial team really shines. The weighted average interest rate across all their debt is just 3.91%, and they've pushed their secured debt maturities out to an average of 7.8 years.
Compare that to current commercial real estate mortgages, which are sitting at 6, 7, or even 8%.
Precisely. They essentially locked in historically low rates for the next decade. They don't have a terrifying maturity wall hitting them next year like so many office or retail REITs do. They have entirely insulated their primary cash flows from the Federal Reserve's current interest rate hiking cycle.
Locking in sub 4% debt for nearly 8 years is surgical financial maneuvering. It completely shields them from current interest rate volatility. But I have to push back on this narrative of invincibility here. Because financial engineering only protects you from Wall Street. It does not protect you from Mother Nature.
That's for sure.
When we look at the physical realities of this real estate, specifically the catastrophic weather risks, is there a chance that the escalating costs of cleanups will eventually erode all of these brilliant balance sheet wins?
It is the single biggest existential threat to their entire model, and to their credit, management's commentary makes that explicitly clear. In this report alone, ELS booked a $7.1 million insurance recovery directly tied to reimbursement for capital expenditures from Hurricane Ian.
And that's just the money they got back. It doesn't capture the immense operational drag of having properties offline for months or years.
Exactly. And if you look closely at their non-core portfolio, which they strategically separate out from their main operating numbers, it reflects properties that are still profoundly struggling. They have 6 properties in Florida still dealing with Hurricane Ian's aftermath, and 2 properties in California heavily impacted by severe flooding events.
Which is a vital point for you, the listener, to understand. When they boast about that 6.5% growth in core property income, they are intentionally excluding those flooded and hurricane-damaged properties from the calculation. They carve out the disaster zones to keep the core numbers looking pristine.
Yeah, you have to read the fine print.
They also noted $0.9 million in non-operating legal expenses this quarter. It feels like the physical and operational friction of maintaining hundreds of outdoor properties is always gnawing at the edges of their profits.
It absolutely is. The financial engineering is pristine, but the physical reality of owning coastal marinas and Florida RV parks means you will always be fighting climate volatility. We talked about how they managed to drop insurance expenses by 2% this quarter by taking on more risk, but the long-term trend for catastrophic coverage in those states is moving violently upward. The persistent risk here is that eventually the sheer cost to insure, maintain, and repeatedly rebuild these non-core properties outweighs the yield they generate.
So, to synthesize all of this deep dive for you, the retail investor, you have a company executing almost flawlessly on the things they can actually control. They are capping expenses through aggressive tax appeals and submetering. They're converting transient weekend visitors into recurring annual members, and their debt profile is incredibly defensive against inflation.
All excellent points.
But they are operating in physical asset classes that are uniquely exposed to extreme weather and serving a consumer base dealing with tightening travel budgets.
Which brings us right back to the ultimate tension embedded in this earnings report. The core manufactured housing segment is an absolute juggernaut. It is providing the deep stability and the reliable cash flow that allows management the flexibility to navigate the volatility of the RV and marina side of the business.
And that dynamic leaves us with a final, highly strategic question for you to mull over as you evaluate this stock. With average manufactured housing rent sitting at a highly sticky, affordable $956 a month, can the incredible reliability of the MH tenant continue to indefinitely subsidize the volatility of the RV and arena business if consumer travel budgets tighten even further, especially as yield management and subscription conversions on those short-term RV sites inevitably hit a ceiling?
Be sure to follow the show for our daily earnings coverage.